Welcome back. Second quarter earnings season gets launched in a big way tomorrow and will continue through the week. Some reports suggest that second quarter earnings per share at S&P 500 companies could drop by more than 8% from a year ago. Let's get some perspective from Laura Lau. She's Chief Investment Officer at the Brompton Group. Thank you for coming in.
Thanks, Paul.
What are you expecting on second quarter earnings in the U.S.?
So what we're seeing is, I'd say consensus expectations are about an 8-9% drop. We got a little bit of a preview last week with some of the big banks reporting, and the earnings were actually better than expected. And one of the sectors that are expected to have earnings drop were actually the banks and financials. So I think what we see typically before earnings season is there's whispers. They tell the analysts things aren't going to be as good as expected, bring those numbers down, and then they get to beat them. So I do think that the 8% consensus number, I believe they will beat that.
There you see JP Morgan Chase, which has rallied along with the other bank stocks over the past several months. What do you think of the bank stocks and their valuations in the U.S. right now?
So they're very attractive right now because they're basically pricing in, the possibility that there could be another banking crisis. I'm not saying that's not possible, but I think most of that left tail risk is out of the market now, and we're also seeing JP Morgan saying that consumers are doing better than expected. And I think there's another thing they can do and cut costs. So unfortunately, that means layoffs. So I do believe that a lot of these banks still have that lever to pull.
And how should we understand the bank stocks with respect to where the Fed is right now in terms of its interest rate hikes? We spoke earlier in the morning about some analysts actually downgrading their ratings and targets on banks because they're looking ahead now to interest rate cuts from the U.S. Fed a year or 18 months out.
So definitely, I'd say a year out, we will be getting cuts. So far, the Fed futures are saying sometime next year. However, I do think that interest rates will be higher for longer. The Fed is trying to make a decision. Do they really want to hold 2% inflation, or is 3% good enough? So we had a 3% number last week. But one thing to remember is a year ago, that number was over 9. So the comparables are easy. And when you look forward, we do think that inflation will be stickier for longer. You already saw United Airlines, higher than expected wage increases. We also saw today with Ukraine, they'll have more trouble exporting grains. Again, higher inflation, and oil looks like it's bottomed. Again, we do think that, with the 3%, that could be a little optimistic to expect that to keep on dropping from here on in.
Investors have been in love once again with the tech stocks this year. Can that continue in the second half of this year?
I do think it can continue, but what I would expect it to do is broaden out. What I mean is, instead of those magnificent 7, those big 7 stocks, that, they will broaden out because a lot of other companies will talk about AI and talk about how IT spending should probably start increasing and benefiting them.
What is your take on S&P 500 valuations generally? The index, as we know, is up significantly so far this year, largely because of those tech stocks. What about the broader valuation picture?
So the valuations are high, especially if you look top level S&P 500. If you actually move down and take out those big 7 stocks, the S&P is not that expensive. So that's why we need some of these other stocks to catch up. But I do think that other global markets are trading a substantial discount to the S&P, and those markets should outperform this year. That
looks like a market that is pricing in a soft landing scenario. Is that what you think investors are pricing in? And are they correct to assume a soft landing in the U.S. economy?
So I would say yes, they are pricing in a soft landing scenario right now. And so far the data still looks good, but it does take time for all of these interest rate hikes to be factored into the consumer, and typically about a year out. And we saw a year after the Fed increased rates, what happened? Well, we had a regional banking crisis. So I do think that people still have jobs, they're still getting wage increases, But if we do have too many layoffs, we might not have a soft landing. But so far, the data shows that we could have a soft landing.
The U.S. consumer, so important to the U.S. economy. What's your take on the U.S. consumer, and what's your outlook on consumer-related stocks?
So the U.S. consumer has been surprisingly resilient, and I think it's because they do have jobs. Unemployment is at all-time lows, and they are getting wage increases and real wage increases. So, you know, they're feeling a little bit happier. The other thing you have to remember is in the U.S., they have 30-year terms on their mortgages. What I mean by that is they've locked in very low interest rates for 30 years. In Canada, it's mostly maximum 5 years. So they don't feel the pain of higher interest rates as much as us as Canadians would. And a lot of corporations have termed out their debt for longer term. So the U.S. economy is not as rate sensitive as Canada is. So as a result, the U.S. consumer can spend longer than we can.
Let's finish with what sectors of the U.S. market you're underweight right now.
So right now, the U.S. market, what we're more underweight would be healthcare, because we're seeing more, we're on a risk-on market, and also consumer staples, simply because we see that the market wants to go higher.